Instead of waiting month after month for your payouts, you're cashing checks every single week. That's the dream, right? Well, Roundhill is about to make it a reality with something brand new, their WeeklyPay Universe ETF, ticker WPA. And here's why it's such a big deal. Instead of forcing you to pick winners like Apple, Nvidia, Tesla, or Robinhood individually, WPA bundles all 15 of their WeeklyPay single stock ETFs into one fund. With a single ticker, you instantly own the entire lineup. And yes, you still get paid every single week. That means one trade, immediate diversification, and exposure to some of the market's most explosive names: semiconductors, big tech, AI plays, even high-risk, high-reward stocks like Coinbase, all while collecting steady distributions. For income investors, this could be a complete game changer. It's not just about chasing yield anymore. It's about creating a portfolio that pays you regularly while giving you upside in some of the most powerful growth stories on Wall Street. So in this video, we're going to break down what WPA is, how it works, the opportunity it creates, why Roundhill built it, how a $10,000 investment across the 15 WeeklyPay ETFs might perform after 6 months, and most importantly, how you can position yourself ahead of its release. If you enjoy this kind of content, don't forget to like, share, and subscribe. It helps us reach more investors like you. Quick reminder, this video is not financial advice. Investing in stocks is risky. Always do your research before making any decision, all right? What is WPA? WPA isn't just another dividend ETF. It's Roundhill's first weekly pay fund of funds, and that alone makes it unique. Instead of focusing on one stock like Nvidia or Tesla, WPAI is designed to capture the entire weekly pay strategy in a single ticker. What does that actually mean? Behind the scenes, WPA follows the WeeklyPay Universe Index. This index is built on all 15 of Roundhill's single-stock WeeklyPay ETFs, and it's rebalanced monthly, so no one stock can overshadow the rest. Whether it's big tech leaders like Microsoft and Apple, high-growth AI names like Palantir and Nvidia, or more volatile plays like Coinbase and Robinhood, WPA spreads your money evenly across them all. But here's where it gets interesting. Every one of those ETFs uses 1.2x leverage to juice the income, and now WPAY packages them together. That means instead of chasing one hot stock and hoping you guessed right, you're holding the entire basket and collecting weekly distributions without the stress of timing your picks. In short, WPAI is built to do two things at once: give you broad exposure to the biggest growth stories on Wall Street and still deliver the kind of weekly income stream that dividend investors crave. So why did Roundhill launch WPA in the first place? The answer is simple: demand. Over the past year, dividend investors have been flooding into WeeklyPay ETFs because they do something traditional funds. Don't they provide weekly distributions tied directly to some of the market's most exciting companies? But here's the catch. Up until now, you had to pick and choose which ones to own. Maybe you believed in Nvidia, or Tesla, or Palantir, but that meant betting on a single name. Roundhill saw that gap and decided to create WPA as a way to let investors hold the entire WeeklyPay roster in one trade. The fundamentals are just as important. WPay is built on 3 pillars. Diversification with consistency. Instead of one company, you get equal exposure to all 15 across tech, AI, fintech, and more. Weekly cash flow. By design, every position in WP pays weekly distributions. That steady income stream is the cornerstone of the fund. Leverage-light structure. Each underlying ETF runs at about 1.2x leverage. That's enough to enhance income potential without going into extreme high-risk territory. At its core, WP is about convenience, stability, and consistency. You don't need to monitor earnings reports, option strategies, or rebalance across 15 tickers. Roundhill does it for you. You just hold one ticker and collect income. That's why WPA has the potential to be more than just a product launch. It's a new way for dividend investors to position themselves for both steady weekly income and exposure to the biggest growth stories on Wall Street. Here's where it gets interesting. Based on recent performance, the average annualized yield across the 15 ETFs has been around 67% paid weekly. Yes, that number is eye-popping, and of course, it comes with volatility. 1-month return, minus 0.06%, equal weighted average. Key takeaways: average yield across all 15 is 67% paid weekly. 1-month average total return, equal minus 0.06%. dragged down by COIW, 27.52%, and MSTW, 16.89%, while most others posted gains. Many funds only launched last month, so longer-term basket returns can't yet be modeled. In a volatile month, WPA would have delivered steady income and stability trade-off. One-click diversification versus chasing top performers like HOOW or PLTW. A launch date, initial share price, and distribution payday for WPA are still unknown, but coming soon. So, what would happen if you put $10,000 into the full WeeklyPay basket for 6 months? At that average yield, you'd be looking at roughly $3,350 in distributions over 6 months before any price movement. And remember, some funds like GOOW, Google, and MSFW, Microsoft, were posting triple-digit yields recently, while others like MSTW, MicroStrategy, struggled. The beauty of WPA is that it smooths those highs and lows through diversification. Question: will you be investing in WPAY at launch or sticking with single-stock ETFs like HOOW and PLTW? All right, now let's quickly walk through the lineup of the 15 ETFs in the Roundhill's WPAY Dividend Investing Income Strategy. Let's start off with AAPW Apple, yield around 32%. Apple's growth has slowed, but it's still a cash flow machine. AMDW, AMD, 66% yield, riding the semiconductor and AI wave, but more volatile. AMZW Amazon, 36% yield, steady growth from cloud and e-commerce. AVGW Broadcom, 56% yield, strong in semis and infrastructure. BRKW Berkshire Hathaway, 84% yield, a slower growth play, but Warren Buffett's name adds weight. COIW Coinbase, 77% yield, high risk, highly tied to crypto cycles. GOOW Google Alphabet, 156% yield. One of the top performers, thanks to AI and ad revenue strength. HOOW Robinhood, 82% yield. Surprising breakout performer, fueled by HOOD stock momentum. METW, Meta, 44% yield. Solid growth in advertising and AI push. MSFW, Microsoft, 104% yield. One of the strongest, driven by AI plus cloud dominance. MSTW, MicroStrategy, 54% yield, but performance has been rocky due to Bitcoin exposure. NFLW, Netflix, 44% yield. Streaming growth plateauing but still cash-rich. NVDW, Nvidia, 47% yield. AI and semis powerhouse volatility, but massive upside. PLTW, Palantir, 61% yield, strong growth in AI plus defense contracts. TSLW, Tesla, 60% yield, volatile but attractive for long-term EV believers. How to position ahead of WPA's release. So, how should dividend investors prepare for WPA? If you're already a fan of weekly income, WPAY could be the safer, diversified way to capture it without betting on just one stock. Instead of trying to guess whether Nvidia, Tesla, or Robinhood will lead the pack next quarter, WPAY spreads that risk evenly and smooths out your cash flow. Of course, if you prefer a little more risk and reward, you can still go after the single-stock WeeklyPay ETFs directly, like GOOW for Google, MSFW for Microsoft, or PLTW for Palantir. But WPA is shaping up to be the set-it-and-forget-it option, the one-ticker solution for investors who want consistent weekly income without overthinking. The fund hasn't officially launched yet, but when it does, expect it to get a lot of attention. For income-focused investors, WPAY could quickly become the go-to way to collect reliable weekly distributions with built-in diversification. And that's the big picture. Roundhill's new WPA ETF, the first-ever WeeklyPay fund of funds. It bundles 15 high-yield single-stock ETFs into one ticker, giving you diversification, income, and simplicity in one move. So, what do you think? Will you stick to individual WeeklyPay ETFs, like Nvidia and Palantir, or will you jump into WPAY for the all-in-one exposure? Drop your thoughts down in the comments. I'd love to hear your take. If you enjoyed this breakdown, don't forget to like this video, subscribe to the channel, and share it with other income investors so you don't miss the latest updates on dividend ETFs and passive income strategies. And as always, this is not financial advice, just research and education. Invest wisely, and I'll see you in the next video.